on capital flows. And it's my privilege to introduce a distinguished panel comprising two senior central bankers and a well-known academic, Dr. Jose de Gregorio, Governor of the Central Bank of Chile, Dr. Jose Sidawi, Deputy Governor of the Bank of Mexico. I think both gentlemen exemplify one feature of central banking that you observe a lot in Latin America, and it's this combination of practitioner knowledge, deep practitioner knowledge, and a career as a professional economist. And finally, in our panel, we have Professor Charles Engel of the University of Wisconsin, who has a number of affiliations and is also editor of the Journal of International Economics. As you may know, the Bank for International Settlements, or BIS, is an institution owned by central banks. And the intention of this panel is to give a forum for a dialogue between central bankers and academics, and in particular to give academics some insights on what issues are of major concern to central banks. We hope that this in turn can lead to research that is of value to central bank policymakers. Before inviting the panelists to speak, I will make a few remarks to introduce our topic today. I will then invite Dr. Governor de Gregorio to make his presentation, followed by Dr. Sidawi, and finally Professor Engel. If there is time, the floor will be open for questions and answers. So let me turn to my introduction with the caveat that the views I express are my own and not necessarily those of the BIS. Many economists think of possible policy responses to capital flows in terms of the so-called impossible trinity or policy trilemma, according to which with an open capital account, a central bank cannot simultaneously exercise monetary control and target the exchange rate. And what we observed looking at monetary frameworks over the past couple of decades is that many countries have made their choice as to where they will lie on this impossible trinity and how they will solve it. And basically, they seek to maintain open capital accounts. They allow the exchange rate to float so as to exercise domestic control, monetary control, often in an inflation targeting framework. And the countries represented in this panel are prominent examples. In practice, however, the choices made by policymakers are not so easy and clear-cut. And you can see this by thinking about the fact that central banks, even under floating exchange rates, still enter the foreign exchange market and intervene. Another fact is that even under floating, you might not get as much monetary independence as you think or as you might expect. And finally, there's the issue that there seems to be renewed interest in capital control. So even when committed to floating, many authorities still enter the foreign exchange market. One motive is prudential, to have enough foreign reserves to deal with financial stress. And as you know, emerging market economies accumulated large amounts of foreign currency during the period of capital inflows up to 2008 and deployed them successfully to counter interruptions in external financing after the Lehman bankruptcy. And one issue is that it's hard to tell when foreign reserve holdings are enough. The recent research suggests that you can't simply rely on a Guidotti-Greenspan, the so-called Guidotti-Greenspan rule that the ratio of foreign reserve cover of short-term external debt should be 100%. In many cases, that foreign reserve cover was well above 100% before the Lehman bankruptcy. And after the Lehman bankruptcy, many central banks whose reserves seem to be adequate have continued to accumulate foreign reserves. So given the impossible trinity, a question is whether continuing central bank entry into foreign exchange market poses risk for monetary control. And we may highlight 3 points. The central banks are very aware of this issue, and they in many cases implement their foreign exchange reserve accumulation so as to minimize the impact on the exchange rate, for example, by pre-announcing a fixed schedule for foreign reserve accumulation. Some central banks occasionally intervene in the foreign exchange markets to influence exchange rates in some way, which can lead to loss of monetary independence. but they will tell you that they do not target an exchange rate level, which would alleviate this concern. But against these measures to mitigate possible loss of monetary independence, foreign reserve accumulation can lead to costly changes in the size and composition of a central bank balance sheet. And there are sometimes concerns that this can make it harder for central banks to sterilize, although there has been success in using interest rate operating targets, which are a kind of automatic sterilization. And another concern is exposure by central banks to possible losses, which some argue can lower the capacity to exercise monetary control. So the second point to note in this trilemma is that you can have monetary independence and maintain your policy rate target, but you can have surges in capital inflows and your financing conditions ease. And then it creates complications for monetary authorities and raises the question of how independent you are, in fact, even under floating. And I'll just, and this is also, and in particular, when policymakers raise interest rates, they might attract more capital inflows. We have heard this concern expressed. And this has generated interest in the use of alternative instruments such as reserve requirements or macroprudential tools. If you're interested in this topic, I would like to invite you to attend the second BIS panel at 15:35 tomorrow afternoon on financial stability and macroprudential policies. And finally, many emerging market economies, including Chile and Mexico, while have favored the maintenance of open capital accounts and flexible exchange rates, as I mentioned earlier. But some authorities have recently sought to restrict capital flows, notably foreign portfolio debt investments. The reasons vary, and I believe Charles Engels will discuss some of the pros and cons. Now, I would like to invite Jose de Gregorio to make his presentation.
Thank you very much. It is a pleasure to be in my first presentation in this Lacea conference after almost 12 years since we did it in Chile last time. I organized it, so I will never forget. It's pretty tough. So it's also a bit ironic, but this is the lags between policy, between organizing conferences, and what are the relevant issues. Because when we start discussing this with Ramon Moreno, it was an issue about capital inflows. And this was by June this year, we were worried, and that was a main topic in many conferences, how to deal with capital inflows. But of course, after August and all the surprises we have had from Europe, the increased risk aversion, so it doesn't seem that it's the most pressing issue for policy making in emerging markets. However, it remains a challenge because we don't know when all these crises in Europe will end. We don't know how it will end. So as a policymaker, one has to make more statements, so be free talking here. We are very uncertain what's going on in Europe and in advanced economies. But in more normal times that should come hopefully soon, but it may take a year or a couple of years, the challenge remains, because in normal conditions, capital inflows should resume to emerging markets and should flow to emerging markets. And this is very simple, because emerging markets are much more stronger economy and offer better returns. It's as simple as that. So capital should flow to emerging markets. And this has implications. It has implications on the business cycle, because it can amplify the business cycle. It has implication on exchange rates, and this has also all the Dutch disease concern and exchange rate pressures, and also has implication on financial stability. So what I will do in my remaining time, I will talk a bit about to look at the facts in perspective of capital inflows. Then I will talk about policy tools and challenges, and finally I will end with some very brief comment. Capital inflows resumed in the second half of 2010, and the reason was because the global economy was recovering from the Great Recession, and so there were a lot of investment opportunities in emerging markets. Investment in stocks and in fixed income by mutual funds recovered significantly. And we are used, I didn't bring it, but to see these figures of capital inflows to emerging markets going up very sharply since the second half of 2010. This also brought some price effects, exchange rate appreciation, stock market prices increases. So the first question is, and I already gave the answer, what caused these inflows? These inflows were caused by differential interest rate, which is part of the adjustment mechanism. If we see at the historical differences, there was not such a big difference, but there was the normal difference, 4 or 5 percentage points of monetary policy interest rates in emerging markets and in advanced economies. And this was very natural because we were in very different cyclical positions. While advanced economies are still struggling to recover and with a very expansionary monetary policy, emerging markets recover very strongly. So in order to keep this recovery sustainable, one has to tighten monetary policy and to control inflationary pressures. So there was this differential interest rate. But I want to insist, nothing abnormal in historical perspective. And also growth prospects. Growth prospects were much better in emerging market economies. And we have seen advanced economies not growing, not closing the output gap, and emerging markets with almost, there is a lot of heterogeneity, but with the output gap on average pretty much close. So there was differential returns, and these were favorable for emerging market economy. However, there is an issue that I have emphasized a lot, and I think that's very important, and it has implications on policies also, is where these capital inflows absorb in net terms, because there is a difference. The previous period of capital inflows, and when the discussion about the search of capital inflows became famous, it may be a bias because I worked with them by that time at the IMF, was Calvo, Lederman, and Reinhardt that wrote this famous paper in the mid-90s talking about the search of capital inflows in emerging market economies and the potential for sudden stop. But if we see at the data during that time, capital inflows were financing increasing current account deficits. In the case of Chile, we had a current account deficit close to 5% of GDP, and this was sort of the average in Latin American countries and even in Asian countries that they accumulate large current account deficit before the Asian crisis in the second half of the 90s. So, but this is the situation today was very different because there was a lot of gross inflows, but there was gross outflows because on average, emerging market economies have current account surpluses. So the capital inflows were not financing an unsustainable expenditure growth, but was much more, they resulted in portfolio diversification. Some economies did the outflows by accumulating reserves, some other economies just by investment in the private sector abroad. Many governments investing in sovereign wealth fund, but in net terms, this was different at the case of the early 90s. This was the case in Chile. In Chile, in the early 90s, as I told you, we had large inflows, large net inflows. We had a current account 5-6% in some years deficit, and more recently, we have had a current account surplus, perhaps a small deficit in the year to come, but current account surplus, some inflows. Most of the inflows were domestic corporations borrowing abroad, taking advantage of very low interest rate. So there was not this, it was not the same story. Anyway, we suffer one thing that all emerging markets have been, I wouldn't say suffering, but experiencing, which is an exchange rate appreciation. But our exchange rate appreciation was not the result of capital coming in, was much more related to a strong economy with very strong terms of trade. So the natural thing is to expect an appreciation. Okay, we may worry about appreciation, but one has to be very careful in the diagnosis because it was not the capital inflows. So the solution was not looking at the capital account in terms of exchange rate pressures. So let me just talk about some challenges and policy implications. It's difficult to try to separate policies because all they are very interlinked. But as I said, we have to take at least two dimensions. One dimension of capital inflows is that the impact on the business cycle. They may be financing unsustainable expansions. Of course, the main risk that we talk, and we said, is a risk of a sudden stop. So our economy become used to a lot of addicted to capital inflows, and for some external reason, there is a sudden stop, and then we suffer a crisis, and it's very costly. So we have to be very careful on the upturn. Now, it's not necessary that there is a sudden stop. This may be just an amplification of the business cycle, of a boom-bust cycle. Not necessarily that we'll end in a sudden stop, but that we'll end with an economy extremely overheat that ends up with a strong adjustment. And because also herding in financial markets, this may deepen the business cycle effect. So that's one issue that one has to think when thinking about policies. This has much more to do with contracyclical policies, monetary and fiscal policy, and things around perhaps the exchange rate and inflation, than with financial system. The other dimension is financial stability. Why? Because also capital inflows create vulnerabilities, excessive, I won't define excessive because it's very disputable, excessive credit growth, financial vulnerabilities in the financial system, currency mismatch, excessive dependence of the financial system on foreign financing, potentially asset price bubbles. And all of these are concerns that we have in terms of financial stability. Another important mandate for central banks, but of course that during the period of the Great Moderation, somewhat forgotten. So what are the tools? What are the tools? In terms of macro and sustainability, we have to use our traditional macro tools. The first one and the first line of defense for capital inflows would be exchange rate flexibility. Why? Because we eliminate one-side bets on our currency that create incentives for capital inflows. And I will close with this because I think that it's extremely important from the policy point of view. Of course, this may not be enough, and I'll comment on that. In an inflation target regime, there is also some sort of leaning against the wind, because as the exchange rate appreciates because of capital inflows, or because in our case of strong terms of trade, this takes out some pressure from inflation if the exchange rate appreciation is persistent. This also takes pressure on monetary policy. There is room for some monetary easing or less tightening, and this takes out some of the pressure for strengthening of the exchange rate. Also, it is important here, fiscal policy. Contracyclical fiscal policy take pressures out from the currency, from inflation, and from the interest rate. It may be insufficient. It may be insufficient because the exchange rate may be subject to extreme tensions. There may be a bubble. The traditional problem that we have in emerging markets, we don't have the typical housing bubble like in advanced economies. What we have in emerging markets are bubbles in all of our assets. So the bubble is on the exchange rate. So it appreciates, and this makes all our assets more valuable. So if we try to fight it, tightening monetary policy, we will create more incentives for carry trade. And this may, of course, make things worse. One has to be careful whether there is not or not a bubble. In Chile, we are very careful about evaluating the stance of the exchange rate because you cannot call all deviations misalignments. Many times this is prone to market forces. But still, you may want to affect the exchange rate, and here you have some tools. The tool that we have used in Chile is foreign exchange market intervention. Of course, this is a deviation from pure exchange rate floating. We did the last intervention that we initiated was at the beginning of the year, in which we announced that we want to do two things. One is to accumulate reserves, because it is always good to have reserves. I will make some comments about that. And second, because we want also to smooth changes in the exchange rate that will appreciate, will be strong because we're a strong country, but this provides sometimes for adjustment to take place in the economy. So foreign exchange intervention has this dual role. One, it serves as insurance because one accumulates reserves, and then you are better prepared to sudden stop. Even what's surprising is that you haven't seen during the global crisis, you haven't seen massive use of reserves because there was not massive sudden stops when you see at all countries around the world. It doesn't mean that reserves are useless because they may just, you are sitting in a pile of reserves and this may serve as a deterrent for sudden stop. So you don't observe the sudden stop precisely because you may have a lot of reserves, so it's not profitable to attack your currency. So accumulating reserves is good to protect financially and boom bust cycle from your economy. But also, exchange rate intervention is direct exchange rate stabilization or some impact on the exchange rate. And this dual role of accumulation of reserves explains why the flexible credit line implemented by the IMF, like an insurance or the original contingent credit line, that was basically contingent reserves. So we pay a fee to the IMF and they say, this is much cheaper than accumulated reserves, and I will, if you need, I will draw very quickly funds for you if you are in a need. But this has been very unsuccessful. So there are just 4 countries that have requested this flexible credit line. And the reason is because the flexible credit line, although it is a good insurance, it may act on the other direction on the exchange rate. First, you won't intervene anymore. And second, financial markets may see that you are so well insured that this could increase some speculative capital inflow. So that's, I think, it hasn't worked. But exchange rate intervention has to be consistent with monetary policy and in terms of an inflation target regime. So the first, it has to be exceptional. So you become addicted to intervention. So you want to make it exceptional, and also it has to be, in order to preserve monetary policy stability, it has to be coherent with inflation target. So you cannot look for a target on the exchange rate because your target is inflation. So you want to keep all the ability, monetary policy independence, so it has to be sterilized. Of course, it is not as effective as unsterilized intervention, like the one that's doing the Swiss National Bank, because they are at 0 interest rate and they just create and create money and to intervene, and it's much more effective than when you have to sterilize, but at least it's a way, and it makes it also more costly, but it's consistent with an inflation target regime. So, and finally, in order to make it even, and this is what we have learned, in order to make it more credible and to make it more exceptional, we also do it in a very mechanical and transparent way. We don't want to fight with the market. We just said we will do some intervention of this amount on a daily basis, and we do it in a pro rata, very standard and simple way. The third, I talk about macro policy, foreign exchange intervention, and now financial regulation. If our concern is our financial stability, we should look at financial regulation. Currency mismatch. This actually, we all talk a lot about currency mismatch. The fluctuations of exchange rates in the late 2008 shows that currency mismatch was well dealt in most emerging markets because currencies fluctuate a lot, and markets and the financial system were very strong. There were some problems in some countries, Mexico, Brazil, because of corporations, Korea, because corporations some of them were heavily exposed to derivatives, but that's also you can include it in the provisioning and in the rules for the financial system to provide funding for doing currency hedging at the corporate level. We have in Chile also not just currency mismatch, we have liquidity requirements in different currencies, provision policies, also restriction on derivative positions. So this is the policies. Even in extreme cases like Korea, one can have a capital levy on foreign debt, what they have been doing in Korea, because they think that the levels of foreign debt to the banking system can threaten a financial stability. And then there is the most debatable tool, which is capital controls. And I don't forget it because I see my friend Jonathan Ostrich here. and the IMF has written, and we all talk that they can be used also as tools if they need it. There is a big issue whether they are effective. And they may be more effective, and this is what experience shows, in economies with low degrees of financial integration. In economies like Chile, for example, if we have a lot of anxiety from foreign investors to bring the money to Chile, we could, let's say, put a capital control. But much more than the capital inflows of foreigners, what we can have is the repatriation of investment of local investors abroad. And that is very different what you can do in terms of capital inflows, especially when are pension funds. Most pension funds in Chile, they cannot be applied capital controls if they want to repatriate their investment abroad, and they are quite sizable. Then there is another issue, which is how you apply it, and this also depends on the deepness of the financial system. So how a foreign investor can find loopholes, and there is always, through foreign investment, there are a lot of things that they can do. In a way, this is there is a bit of a cynical or incoherent view sometimes I see in policymakers, that on the one hand, they said, please come to my country, that's great, and we want to grow, and we welcome investment, and on the other hand, they say, but we have to control them. And this is a bit of schizophrenia. It's kind of bothersome from the point of view of applying the right policies. And for that reason, I think that taxation or plain controls and broad-based may be more effective if one wants to be less exposed. I think the experience shows that and if we see how resilient were different economies, it didn't depend whether they apply or not capital controls. It were much more important how sound were the financial system and how strong were financial policies. And this is what I want to do with my closing remark. We used to talk, and I try to think about this. It looks like I'm at the end, but it's very brief. The first talks, and this Calvo, Leiderman, and Reinhardt, they talk a lot about these push and pull factors of capital inflows. By push factors were things abroad, I star, foreign interest rate. Pull factors were domestic factors, I. It's difficult to separate because what makes capital inflows is I minus I star. So you say, well, I call it I star push, and it's difficult already for me to think about push and pull factors because the pull factors are just the real high returns that you have, and push factors perhaps a very weak global economy. However, there is also pull factors that are policy distortions. And I think that that's also what some experience has shown. Countries with misaligned interest rate, with very high interest rate, countries, part of this happened to Chile during the 90s. Countries with very high interest rate and also trying to control or to target the currency. So high interest rate with the defense, with the weak defense of a currency is a stimulus to capital inflows because you want to get in because there are high interest rates, but you want to get in before they give up with the defense of the currency. So there is also, I think, that the attempts to avoid appreciation or to make them quote unquote smooth, so our exchange rate will appreciate, but gradually may create incentives for more capital inflows, for financial vulnerability. So I think that the first thing that from the point of view of policymakers we should look at when thinking about capital inflows is first, what is the source of the appreciation, what is the source of the capital inflows, and how coherent is the whole macroeconomic framework to deal with these tensions. Thank you very much.
I'd like to start by thanking the BIS for their invitation to participate in this panel. In the presentation today, I will talk about some of the challenges posed by capital flows to emerging market economies, in particular to Mexico, and focus on the driving forces that Jose de Gregorio, some of the driving forces at least that Jose de Gregorio was referring to, and on how policymakers cope with them. Needless to say that the views that I express here are entirely of my own and do not represent those of Banco de Mexico. Since the emergence of the global economic crisis, movements in capital flows have been exacerbated. The current environment poses two main challenges. The first is the need to rebalance demand across different economies. Those with excess savings should direct policy toward increasing domestic demand, and those with insufficient savings should strive to adjust domestic demand to sustainable levels. The second challenge is how to deal with the abundant global liquidity induced by loose monetary policy in advanced economies, which resulted in record low interest rates. Usually, capital inflows have allowed emerging markets to benefit from them because they allow economies with insufficient savings to access foreign resources, to finance domestic expenditure, to promote growth. However, they have always posed challenges. Furthermore, new challenges arise from the current global economic environment. Among them, the sheer size of capital flows and their source, the abundance of liquidity. Despite the recent turmoil, several analysts claim that if world financial markets were to calm down in the wake of a positive outcome of the European problems, emerging markets are likely to receive more capital in the near term. Loose global financing conditions are likely to persist for a while, and to the extent that emerging markets perform better than advanced economies, capital may flow towards them in significant volumes. Policymakers in emerging markets need to address the risk associated with capital inflow surges. The right policy prescription depends on the nature of those capital flows and the specific conditions in each country. In my view, an important issue is whether capital inflows are mainly driven by improved economic fundamentals or are primarily driven by the abundance of global liquidity. I shall group the latter under the label of carry trades. Although in theory it may seem feasible to discriminate between fundamental and carry trade capital inflows, in practice it is very difficult to disentangle the two. Nevertheless, one should make every effort to differentiate between them, as the distinction has important implications for policy. When capital inflows are driven by economic fundamentals, then the adjustment, as Jose said, calls for an appreciation of the equilibrium real exchange rate. The policy response should be geared towards allowing markets to function freely in order to facilitate the transition towards the new equilibrium real exchange rate. When they are driven mostly by short-term profit considerations, such as carry trades, then the response should be a mix of monetary, fiscal, and financial policies to prevent misallocation of resources. Avoiding misallocation quite often entails implementing policies that should, in turn, also prevent booms and busts, the misalignment of asset prices, and of the exchange rate. The surge in capital inflows to emerging markets observed in the second part of 2010 and in the first part of this year appears not to be mostly driven by fundamentals. Instead, these flows appear to be related to carry trade operations, given the wide interest rate spread between emerging markets and advanced economies. Under these circumstances, global external factors play a prominent role. As soon as external conditions change, there is often a rapid change in risk aversion and a sudden reversal of capital flows. At this juncture, policymakers from several emerging markets have attempted to offset the exchange rate appreciation. Very often, they have ended up intervening in the foreign exchange market, accumulating substantial amounts of international reserves, and incurring in huge social cost without achieving their objective. Countries with inflation rates below the central bank target could respond to portfolio capital inflows by relaxing their monetary policy stance. By doing this, they narrow domestic and foreign interest rate differentials, thus reducing the appeal for carry trades. Oftentimes, however, policymakers have limited degrees of freedom when choosing the response. Consider the case of those countries with inflation rates above their central bank's target. relaxing their monetary policy stance is just not an option. A similar limitation appears when it comes to fiscal policy. Whereas the traditional prescription is that, other things being equal, fiscal policy should be tightened in order to induce a depreciation of the real exchange rate, several countries have actually done the opposite in response to the downturn of the business cycle, expanding fiscal policy in order to provide a contracyclical stimulus to their economies. Now, let me turn to the Mexican experience. In 2010 and in the first 7 months of this year, the country received a significant amount of capital inflows. In the last quarter, however, as a result of the renewed turmoil in international financial markets, there was a reversal of these capital flows, mostly short-term, and a significant depreciation of the currency. We have not been able to draw a clear distinction between capital inflows that are related to fundamental reasons and those fueled by carry trades. However, the analysis of a series of statistical indicators coupled with market intelligence suggests that an important part of these capital flows received in the last couple of years are primarily driven by fundamentals. Over the past 2 years, the country has received roughly $70 billion, of which 44% were foreign direct investment, while the rest was portfolio investment. Within this category, nearly $28 billion were invested in long-term government bonds, while the rest were invested either in short-term debt or equity instruments. In this setting, open and developed domestic financial markets have been an important factor behind capital flow into the country. For instance, Mexico was included in Citigroup's World Global Bond Index, the WGBI, almost a year ago. The current weight of our debt in this index stands at 0.6%. According to Citibank, numerous asset managers and institutional investors replicate the index for an amount close to $2 trillion. Thus, there is a reason to believe that they are the ones behind a large proportion of the capital flows the Mexican economy has attracted. Following the inclusion in the WGBI, the holdings of long-term bonds by foreign investors have grown quite rapidly, and today account for more than 40% of the total outstanding. Therefore, one may argue that the profile of foreign portfolio investors in Mexico has changed. It is also true, however, that carry trade opportunities have attracted short-term capital flows. Most of the recent interest in this type of investment was channeled through position in derivatives on the foreign exchange market. In addition, an appetite for this type of investment was present in the short-term government paper SETE market. During the most recent episode of volatility, we witnessed a sudden reversal of a large part of these flows. Investors reduced their positions in the over-the-counter market. There was an outflow of more than $13 billion. The same is true when one looks at the SETE holdings, which declined by 25% during that period. In Mexico, as in many other emerging markets, capital inflows impose on policymakers several challenges. In our case, this did not appear to be as significant as in other countries. None of the challenges so far pose a major threat to financial stability. Allow me to underscore a few facts. First, capital inflows did not lead to a credit boom, nor did they stimulate disproportionate leverage on the part of households or firms. Indeed, different credit indicators have been growing at a pace consistent with the business cycle, while the level of non-performing loans has declined from the peak reached during the financial crisis. Furthermore, there is simply no evidence of an asset price bubble in any relevant market. Second, external accounts were and still are compatible with a stable, balanced path. While non-oil exports have continued to grow at a healthy pace up to this day, 17%, imports of consumption goods have barely reached their pre-crisis level. Furthermore, there is no evidence of an unsustainable growth in consumption. Further, the current account deficit is still less than 1 percentage point of GDP and can easily be financed. Overall, it appears that capital inflows during the period when the nominal exchange rate was appreciating did not lead to a serious or a persistent misalignment of the real exchange rate. Third, capital inflows did not lead either to a higher inflation in prices of non-tradable goods. Quite the opposite. Inflation in this sector is running at 2% and has steadily been falling during the last 9 months. Finally, although most of the main banks in Mexico are subsidiaries of European banks, Mexican institutions have remained well capitalized and closely supervised, which has enabled them to continue expanding credit. Thus, the presence of these global banks has not resulted in a reversal of capital flows or impaired their ability to carry out their business in the local market. This said, and looking ahead, policymakers in Mexico still face a number of risk factors stemming from capital flows. Perhaps among the most important is the possibility that additional inflows could lead to a pronounced exchange rate appreciation and thus to exchange rate misalignments and distortions to the real sector. On the other hand, there is always the threat of a sudden, disorderly reversal of flows on a major scale with potential to destabilize domestic financial markets. Before describing the specific policies implemented to address the large capital inflows, allow me to make a background comment on the macroeconomic policy stance. The government carried out a fiscal reform in 2009 in response to the need to improve upon the situation of the public sector finances, rather than as an explicit policy to address capital flows. With the benefit of hindsight, after the crisis in Europe, Mexico did the right thing at that particular juncture. As mentioned, the appropriate monetary policy response should have been to reduce the policy rate to narrow the differential between domestic and foreign interest rates. However, at that time, inflation was still above our target. The central bank had to make additional efforts to consolidate price stability and to bring inflation to the target. Thus, there were no degrees of freedom to relax monetary conditions. In this way, sound macroeconomic policies have implicitly been part of the response to capital flows. Thus, given the fact that there were almost no degrees of freedom for further explicit actions on the macro front, in general, the policy response to capital flows has rested on two pillars. The first has been to allow for an orderly exchange rate adjustment. Financial authorities have been committed to a floating exchange rate regime and have implemented policies geared towards enhancing the regime's resilience. Moreover, regulators have refrained from introducing measures to restrict capital mobility, allowing markets to function freely. Exchange rate movements have probably provided the most important element of the financial and economic adjustment to capital inflows. The second pillar of the policy response has been to take advantage of these capital inflows in order to reduce economic and financial vulnerabilities. The central bank has replenished its stock of international reserves by using a rule-based accumulation mechanism. The stock of international reserves is now almost $58 billion higher than before the collapse of Lehman Brothers, a time when the level of reserves was deemed by rating agencies and other analysts to be too low, especially when compared to those of Mexico's peers. The increase in international reserves has been fueled by two sources: oil-related revenues from the state-owned monopoly, Pemex, and direct purchases from the market through a put option mechanism. To complement these resources, a flexible credit line with the IMF was negotiated. In our view, this has been a cost-effective way to increase international reserves. Here we may differ a little bit from Chile's view. These actions have reinforced investors' confidence. In particular, in a context of strong fundamentals, the country has been able to take advantage of the abundant liquidity to promote the development of domestic financial markets, which has brought great benefits. Some of the most important ones are as follows. Interest rates of government paper have declined more than 200 basis points from their peak, with positive spillovers in the private sector. Furthermore, the government has been able to extend the duration of its peso-denominated debt to 7.5 years, making it less vulnerable to the refinancing risk. The presence of foreign investors has reinforced domestic regulators' commitment to continuously improve upon the financial market infrastructure. Sophisticated foreign investors have been prodding domestic institutional investors, such as pension funds, making them more efficient. Thus, domestic institutional investors and foreign investors have played a key role in fostering the demand for long-term debt instruments and in supporting the development of the market for derivatives. Increased investors' appetite for Mexican exposure allow also the government to improve its presence in the sovereign dollar-denominated debt markets. Recently, a 100-year bond was issued with a yield to maturity of less than 6%. Moreover, local corporations have also benefited from this environment. Finally, the flexible exchange rate regime and the improved confidence among market participants have allowed the peso to become a global currency. According to the BIS data, the Mexican peso ranks 13 among the most traded currencies in the world. Its volume has almost doubled in the last decade, and the market is liquid and deep and operates 24 hours a day. Despite of the benefits of current policy, it could have important drawbacks. First, international reserve accumulation has expanded liquidity considerably in financial markets. Banco de Mexico has been forced to increase its peso-denominated liabilities in order to sterilize this excess liquidity. Fortunately, there is no clear evidence that this policy has, so far, had any negative impact on interest rates paid by the central bank. However, there are limits regarding to the extent to which the central bank can sterilize its purchases of foreign currency. There is a quasi-fiscal cost corresponding to the difference between what the central bank earns on its international reserve and what it pays on its domestic debt. Second, excess liquidity has also changed the way monetary policy is implemented. Since 2010, open market operations have been used to drain liquidity on a daily basis from the market, which contrasts with the historic behavior of the central bank as provider of liquidity in that market. And finally, there is another source of risk. Foreign investors hold a very large share of fixed income securities, particularly in the middle segment of the yield curve. Of course, this poses a potential risk should a massive sell-off take place, which could be a threat to financial stability. Thank you very much.
So I also want to thank Ramon and the BIS for inviting me here. It's a little bit of a tricky situation I find myself in because Ramon asked me to present the academic perspective on capital flows and policies to cope with them, but Jose de Gregorio is really one of the leading contributors to the academic literature on capital flows. So, I mean, I'm not sure what I should be doing up here. Although I have to say that I feel like I have a lot more freedom as an academic. When I just heard the previous two speakers talk, I felt like they had to be careful what they said might influence markets. But an academic, never has to worry about that. I could say anything and markets wouldn't move. So let me just start my perspective, and I'm going to really focus mostly on policies that are meant to limit capital flows and what might be the justification for that, and what are the problems with it. And I'll really focus mostly on policies that limit capital inflows. Actually, in fact, policies that are meant to prevent capital outflows generally have the impact of reducing capital inflows, because foreign investors then are wary about bringing their money in because they may not be able to get it back out. So in fact, a lot of what I have to say would apply to policies that limit outflows as well. So I want to start by delivering a warning, which is that I think problems from the academic perspective of thinking about these things, that they're difficult issues, and I don't think there's any clear-cut conclusions either in the theory of capital control policy or in the empirical work on capital control. So let me just point out a couple of problems up front. First, it's easy to come up with reasons why it might be optimal policy to put on some kind of capital controls or other policies that limit capital controls, or at least it might be a welfare improving second best policy to do so. But that's, those are theoretical reasons, and the problem with enunciating those is it doesn't say much about the practical limitations of implementing that kind of policy. I mean, a lot of the models we talk about in economics are models where a planner achieves the optimum. We always talk about, well, here's the social planner optimum, as if, if we only had, it sounds like if we only had a centrally planned economy, we would reach the most efficient outcome. But of course, that's not true, and it's not what the literature means. But the problem is that the literature doesn't deal well with the political constraints, and it also doesn't capture well the power of the market in allocating resources. So I can mention issues where the markets fail, but it's not clear that policymakers really could do better. The second thing I want to mention before I even get into things is talking about the empirical literature. When I get to that, I'm going to mention that, as Governor De Gregorio already mentioned, that there's a question of whether controls on capital are even effective anyway. If we put on controls on capital inflows, would they really prevent or would they really reduce inflows? But the problem that this literature faces is a lot like I think a problem almost any literature on macroeconomic policies face, which is that policies are not randomly assigned. We don't say, okay, this week Switzerland, all the countries whose name starts with S have to put on capital controls, and then let's run that experiment and see what happens. And then next year, all the countries whose name starts with Z will put on capital controls. Instead, any policy is always implemented in response to something, and so countries that have implemented controls on capital inflows have implemented them in response to surges in capital inflows, and so it's difficult to tell whether these policies actually have limited flows, because it's difficult to say what would have happened had the policies not been in effect. I mean, that's exactly the reason we can't really measure the effects of fiscal policy very well these days. I mean, there's a big debate about, what's the fiscal multiplier, but exactly the reason there's a debate is that we only implement expansionary fiscal policy during a downturn. And so depending on how you've controlled for the fact that the policy is done in response to something will determine, what you measure is the effectiveness of the policy. I mean, we could conclude, for example, to give another analogy, we could conclude that, hospitals are very ineffective in treating the sick because a lot more people die in hospitals than die outside of them. But, that's obviously, there's something wrong with that type of analysis. So with those caveats in mind, I think, the bottom line here is we're not going to be very conclusive, but I at least want to offer a framework to think about, or maybe how an academic would think about the issue of controlling capital flows. So there's a recent survey by Magoo, Reinhardt, and Rogoff, and they list 4 potential objectives of capital controls. The first is to reduce the volume of capital flows. The second is to alter the composition of capital flows toward longer maturities or changing the exchange rate composition of capital flows. A third objective would be to reduce real exchange rate pressures, and a fourth objective would be to allow for more independent monetary policy. But the question is, why should these be objectives? Why should those be policy objectives? And what I'd like to try to do here is take what I think of as a modern macroeconomic view. And a modern macroeconomist thinks about policies. The rationale for implementing policies is because there's some market failure, there's some inefficiency in markets, and that's why we need to implement a policy. So, for example, the inflation targeting literature, the intellectual rationale for it really involves the distortions that are caused by inflation, especially in a world where prices aren't continuously reset. So the question I want to ask here is, well, what's the problem with capital inflows? Why do we need to even think about limiting them? I mean, if a country's running a current account deficit, that might be completely efficient. It may be a very good idea that foreign investors are bringing funds into a country with highly productive investment opportunities. You know, what's the problem with hot money flows? What's wrong with investors seeking the highest possible return, even if it's short-termism? I mean, what could possibly be wrong with that? Because, you know, after all, I mean, that's how an efficient market is supposed to work, is that entrepreneurs seek out profit opportunities. And by the same token, you know, what's the problem with the swings in exchange rates? Why should it be a problem that the currency is appreciating? Maybe that's the right, leading to the right relative price response, given the country's productivity growth or productive investment opportunities. So in thinking about that, I tried to make a list of distortions that I think the literature has at least in the back of its mind when it talks about the rationale for controlling capital inflows and in some cases limiting exchange rate fluctuations. And I divide those first into 2 larger groups. One is distortions that have to do with the capital markets themselves, and then a second group are not really capital market distortions, but they are nonetheless cases where you might want to use capital controls as a way to control the exchange rate. So they're distortions that lead to misaligned exchange. So let me talk about those 2 separately and start by talking about capital market distortions. So a lot of times there's this discussion of these waves of capital inflows, and implicit in the discussion is that there's something irrational. Markets become overly enthusiastic. They see an investment opportunity, and they think, well, this is a great place to invest, and let's go for it. And I mean, it's hard for an economist, particularly an academic economist, to say, oh, yeah, there are bubbles out there, and we need to do something about them. But on the other hand, it's hard to deny, given recent evidence that there are bubbles. I mean, it's hard to think about the housing bubble in the U.S. as anything other than a bubble. I mean, maybe I would describe it not as irrationality, but maybe as a lot of optimism. And what's wrong with a lot of optimism is that there are irreversibilities, for example, in investments. So if investors are very optimistic about Chile and investment projects start, but then investors are very fickle and they change their mind, the problem is that these projects can't be unwound very easily. So these irreversibilities intermingle with this possibility of bubbles or waves of optimism. So certainly that seems to be behind some of the concern about capital inflows. A second thing I think is that the problem that financial institutions just take on excessive risk. Citibank may be just lending too much to an emerging market, and why are they doing that? Well, I mean, we know now a lot of reasons. I mean, anybody who has been on Earth the last 3 years can probably list 15 reasons why banks are taking on excessive risk. Maybe their compensation scheme rewards taking on excessive risk, or maybe it's because they know somebody's going to bail them out, or maybe it's because markets are opaque and they can get away with taking on excessive risk. But that's a concern for policymakers if say, hedge funds in the U.S. or investment banks in the U.S.